Duret, do you feel central bankers, with their aggressive easing and post-crisis regulatory zeal, have been the assassins that have fired that final bullet into the still wriggling corpse of modern portfolio theory?
They have really put the nails on the coffin by pushing down the yield to levels where the notion of risk-free rate is put into question by any asset managers, and pushing, let's say, our work to its limit, where we need to question where are the source of income, where are the asset class that could diversify. You know, the role of bonds is questioned now, and we need to find alternatives for bonds in terms of income or in terms of diversifying role. And the future is probably to look at these alternatives. We may look at alternative investments, specific managers, source of alpha, but it will not solve the problem of the blocks that we have, meaning that we may go in a direction where the equity blocks should be increased, but we need to manage it, you know, whether we go in that direction. Or we need to think to expand the alternative space and give more room for unusual investment source of alpha. There is no borders. If you look at the equity world, we are saying that, you know, the correlation has increased, but in fact, the world of equities has been expanding. We have been exploring, you know, the world of emerging market has grown to some form of maturity. We have the frontier market. We have other illiquid assets that we can have access to. I don't see a limitation there in the field, in the scope for diversification, and this is really our job.
And if we're talking about this diversification, Bill O'Neill, how will the choice for most wealth managers work? Will they rethink their strategic asset allocation and work with much more limited tactical bets, such as thematic investments?
Well, I think thematic investment is an accompaniment to an investment process, or dare say basically an output of an investment process. You know, basically discretionary managers would argue that, for instance, that a lot of thematic investment is captured in their positioning, you know. And I think it's extremely important, but in terms of the way we're looking at strategic asset allocation at the moment, it's things like, for instance, looking at credit as a substitute for equity, you know, lighter returns relative to equities, but certainly, you know, volatility, risk characteristics that actually matter. But in bringing it all together, you are still focusing very much increasingly on drawdown risk, you know, conditional or otherwise. Clients want to see basically, in a worst case scenario, how well or how badly are things going to actually perform before it's going to perform. And that's a concept I think that clients can focus on, because essentially it's a pounds and pence story.
And talking about pounds and pence, I'd like to flick the coin and let's look at it slightly differently. The option of old style strategic asset allocation combined with the fairly timid, limited tactical maneuvers, does this still have a future? Or do we have to be braver?
Well, I would say we need the combination, and that was mentioned already. So you need to have this kind of long-term asset allocation, or at least your strategic asset allocation, and then to be able to adjust this. Having said that, and with what we've been saying about the change in the financial theory, I think that you shouldn't only rely on your strategic asset allocation and your classical type bond investments. It was mentioned the concept of bonds proxy, for example, where bonds used to be the assets giving you the income, something which you can actually expect, you know, to have the return you actually invested it for. So going forward, if we look now at the output of a traditional optimizer, I would say, that has been actually built in a decade where interest rates were going down, the optimizer may tell you actually that if you only base your decision on the past, you should continue to invest in bonds. Well, we all know that there is a big chance that at some point interest rate may go up. Of course, it may not happen next year, but at some point it will happen. So only basing your decision on this when you build your portfolio wouldn't be appropriate. So How do you do now? Well, maybe you try to diversify your strategic asset allocation with other assets. So what can you invest? Maybe you could look at infrastructure products. This is a way you can invest in economic infrastructure, such as products based on the return on the income from roads, tunnel, or social, also maybe infrastructures, hospital, even prison, this kind of thing. That would deliver you some income. You could also look at maybe real estate. This is something people are more and more looking at. You need to look at other ways to increase your income. And there, I think we're not talking about only tactical asset allocation. We're talking about completely changing the way you are looking at your strategical asset allocation.
One of the main problems we've got now is the fact that we are seeing changing anchors, I would say. And we've got to redefine those anchors. If I take the risk-free asset concept, this is one example. It's not an absolute concept, it's a relative concept. It's related to the liability side of the investor. This is one example. Equilibrium levels of asset classes. We are lost in some transition. What is a core asset of portfolio? We know for sure that monetary policies are no longer rule-based, and this is a key point. So we've got a general topic about redefining what the anchors of the system are. Second comment on central banks. If I may, we've got to convince ourselves that we are seeing a shift, definitive shift in DNA in the West, central banks level. The Volcker period is coming to an end. We are moving in a non-rule-based story, multi-objective, multi-tools, and this is to stay with us, with implications. One is the clear risk to be trapped into fake alpha, basically capturing risk premia on hidden fat tails. The second is the big question: should we buy into rational bubbles? Because rational bubbles will be part of the new monetary environment, and this is. And the last remark I would like to make is the fact we've got a combination of the flawed aspects of what we call theory, or at least the way they were interpreted, and the impact of the QE infection thing. And the combination of the two things are leading to what I call the temptation of obscurantism across the investment space, meaning the temptation to give up on long-term investing, to give up on value considerations, to hide into so-called risk-neutral, passive, cap-weighted strategies. And this is one of the biggest challenge for the investment committee to be able to stand for investment beliefs and clear and new, eventually new definitions.
Well, I think a lot of the things that we talk about are basically around three elements, and I mean basically captured most of them. And I think from where we are coming from, in order to solve a number of the issues, you need to create more innovation on basically everything that we're doing. That means that you need to be more innovative on basically what are the building blocks that I use to build my portfolio, and basically look at what is the return stream that they represent, and does that return stream make sense from an objective perspective and from a correlation perspective. And that may be traditional asset classes at some point in time, but in many cases that will be different type of things. And in most cases, a more factor-based, let's say, approach to building an equity portfolio may be a better way, for the simple reason that there aren't any derivatives yet, there aren't any indexes yet to most degree for these type of things. So that is a way of innovating your portfolio model. The second is on how do you do portfolio construction. Using more risk balancing in your portfolio construction methodology will improve the overall way of how you build your portfolios. And the third one is on risk management. Basically creating a much more dynamic approach to risk management. You cannot assume that, let's say, relationships remain the same over a longer period of time. You cannot assume that your stakeholders will allow you to stick for the next 10, 15 years with the portfolio that you have. You run the risk if your drawdown, if your intra-horizon volatility is too high, that your stakeholders will tell you to change your investment policy and you lose the control over your portfolio. And those are the things that are going to be crucial in the coming period, in my view. And that all has to be balanced against the objectives of the client. The client, you need to agree with the client. What are the return expectations? Are they realistic? And Mr. Client, do you understand what the consequences for risk is? Over the last 30 years, we basically have been in a return-driven environment. We've only talked about return and return opportunities. We haven't basically made our client well aware of the risks that a certain investment policy is leading to. In the crisis, we weren't killed by active managers. In the crisis, we were killed by beta. Active managers did not underperform by 60%. It was equity markets in some areas that went down to that degree. And that is conceptually what people need to understand. Risk premia are not stable. We all try to get risk premia. That's the easiest way to get returns. But your ex-post and ex-ante-risk premia are very different. You cannot expect that fixed income markets in Europe like last year will again produce 14%.